Picture this. It's a Saturday afternoon, and you're standing in the kitchen of an open house. The countertops are quartz. The light coming through the windows is perfect. The realtor is smiling at you like you've already made the decision. You're running the numbers in your head: 20% down, 6.5% interest, 30-year fixed, and you start to think, maybe this is the one. But here's what nobody in that house wants you to know. The same property you're about to make an offer on is statistically likely to be worth 5 to 15% less in 18 months. The mortgage you're about to sign will be the most expensive financial commitment of your entire life. And the trap most buyers are walking into in 2026? It's not the price tag. It's something almost nobody is talking about. So today, we're going to break the entire thing open. The exact mechanics of why 2026 is the riskiest year to buy a home in over a decade. The 5 layers of the trap. And the way out, including the 5-question framework you can run on any house right now today. My name is Jenna, and I spend way too much time obsessing over housing markets, mortgage math, and the financial traps disguised as opportunities. I track Zillow forecasts, Reventure regional data, mortgage rate movement, and the exact dollar math behind every "should I buy now" decision regular people are wrestling with this year. Hit that subscribe button and give this video a thumbs up so the algorithm shows you the next one. Because if you're a sideline buyer right now, frustrated, watching prices, wondering if you're missing out, this video is going to give you the mathematical permission to keep waiting. And if you're ready to buy, the exact framework to do it without falling into the trap. The 2026 housing market did not happen by accident. It is the direct result of 3 specific decisions, stacked on top of each other. Rewind to 2020. The Federal Reserve drops interest rates to nearly zero. Millions of Americans refinance their existing homes at 2.9%, 3.1%, 3.3%. Some at even lower. These people become what economists now call the locked-in generation, homeowners who have absolutely no incentive to ever sell. Because every other home they could buy comes with a 6.5% mortgage attached to it. Fast forward to 2022. The Fed reverses course and starts hiking rates aggressively to fight inflation. By 2023, the average 30-year mortgage rate hits 8%. House prices, against all logic, don't crash. They just stop moving. Sellers refuse to list. Buyers refuse to buy. The entire market enters what analysts now call the Great Freeze. Now we're in 2026. And here's where the trap gets interesting. Mortgage rates have come down slightly. They're hovering around 6.4%. Just low enough to convince some buyers that now is the time. Inventory has finally started climbing. And then, in February of 2026, Zillow announced something unprecedented. They slashed their growth forecast for the entire year from 1.9% down to just 0.5%. A near total reversal of their previous outlook. And Reventure's predictive models now show actual price drops happening in roughly 50% of major U.S. metros. Which means, if you buy the wrong house, in the wrong metro, at the wrong moment in 2026, you are very likely walking into the worst housing trade of your life. So that's the setup. Now, let's get into the 5 layers. Layer 1 of the trap. The mortgage rate standoff. Here's the math nobody walks you through when you're staring at that quartz countertop. A typical buyer in 2026 is looking at a home priced around $400,000. With 20% down, that's a $320,000 mortgage. At 6.4% over 30 years, your monthly principal and interest comes out to roughly $2,000 per month. Not your tax. Not your insurance. Not your HOA. Just the loan. Over the full life of that mortgage, you will pay the bank approximately $320,000 in interest alone, meaning the actual cost of your $400,000 house is closer to $720,000 by the time you're done. Now here's the trap. The previous owner who's selling you that house? They financed it in 2021 at 2.9%. Their lifetime interest paid is $150,000. You are paying more than double for the exact same physical house. And here's the worst part. If rates drop in 2027 or 2028, which is what most economists are now projecting, that previous owner could already refinance to a lower rate if they ever wanted to. You cannot easily refinance out of this mortgage without paying thousands in closing costs and resetting your entire amortization schedule. You're locked in at the worst time with the highest interest cost in a decade. That's layer 1. And it's only the beginning. Layer 2 of the trap. The localized bubble. Here's something most real estate content gets wrong. There is no single national housing market. There are roughly 400 regional micromarkets, and they are all moving in different directions right now. Some are still appreciating, some are flat, and some, and this is the trap, are actively deflating, even while sellers in those markets are still pricing as if it's 2021. The metros currently most at risk for price corrections in 2026, according to Reventure's regional data: Austin, Phoenix, Tampa, Dallas, Houston, Boise, Cape Coral. These are the metros that saw the most aggressive pandemic-era appreciation, the highest investor activity, and now have the most inventory sitting unsold. In some of these markets, asking prices are still anchored to 2022 highs. But actual closed sale prices? They're already 5, 8, even 12% below those asking prices. The trap is if you're a buyer in one of these metros and you don't know how to read the data, you're going to anchor to the asking price. You'll assume you got a deal by negotiating $10,000 off. But the real market value could be $30,000 below where you're closing. You're not just buying at the top. You're buying $20,000 above the top. And then watching comparable sales in your neighborhood drop for the next 12 to 18 months. Layer 2. The most expensive 5% of any housing decision happens right here in the metro selection. Layer 3. The forecast reversal trap. In November of 2025, Zillow's research team published their 2026 housing market forecast. Growth projection 1.9%. Modest, but positive. Most agents, most brokers, most sellers use that forecast as their pricing anchor. Their entire pitch was prices are still going up just by now. 3 months later, in February of 2026, Zillow published a revised forecast. Growth 0.5%. They cut their projection by nearly 75%. Almost overnight. Now, half a percentage point might not sound like a big deal. But let's translate it. On a $400,000 home, 1.9% appreciation means you'd gain about $7,600 in equity over the year. 0.5% means you'd gain about $2,000. But after paying $12,000 in closing costs, $6,000 in property taxes, $1,400 in insurance, and another $24,000 in mortgage interest, you haven't gained equity. You've lost it. And this is just the headline number. In the 50% of metros where Reventure is showing actual price declines, the math gets dramatically worse. You could lose $10,000, $15,000, even $20,000 of equity in your first year of homeownership and still be making your mortgage payment every single month. That's layer 3. The math doesn't care how much you want the house. Layer 4. The true cost of ownership math. When most buyers calculate, can I afford this house? They look at the mortgage, the principal and interest. Maybe they add property tax. They convince themselves they can pay $2,300 a month and that's that. But here's the actual full monthly cost of owning a $400,000 house in 2026. Mortgage principal and interest, $2,000. Property taxes, averaging $6,000 a year or $500 a month. Homeowners insurance, averaging $1,800 a year or $150 a month. Now this is where most buyers stop calculating. But you have to keep going. Maintenance and repairs. The general rule is 1% of the home value per year. That's $4,000 a year or roughly $330 a month. HOA fees, if applicable, averaging $250 a month nationally. Utilities, averaging $300 a month. And here's the one almost nobody factors in: the opportunity cost of your down payment. $80,000 in a high-yield savings account at 4.3% would earn you about $300 a month in interest. You're forfeiting that to put it into your house. Add it all up. Your $2,000 mortgage, actually costs you about $3,830 per month. Almost double the headline number. And that's before you factor in any of the appreciation losses we just covered in Layer 3. If you're stretching to afford that mortgage payment, you are not stretching to afford a mortgage. You are setting yourself up to be house poor. Layer 5. The insurance wildcard. This one almost nobody is talking about, and it is going to blindside thousands of 2026 buyers. Homeowners' insurance rates have surged nationally by an average of roughly 20% over the past 24 months. In high-risk states, Florida, California, Louisiana, parts of Texas, premium increases have hit 40, 50, even 70%. Some carriers are exiting entire markets. Florida has lost multiple major insurers in the past 3 years. California's largest insurer paused new policies in fire-prone areas back in 2023. So you do all your math. You calculate your mortgage, your taxes, your insurance at the current quote of $1,800 a year. You close on the house. 12 months later, your insurance renewal arrives, and your premium has jumped to $2,800. The year after that, $3,800. The year after that, your carrier drops you and you have to find a new one at $5,000 a year. And here's the trap. You can't easily move. You've already paid the closing costs. You've already put down 20%. You're locked into a 6.4% mortgage. The insurance is now a fifth of your monthly payment. And there's almost nothing you can do about it. The 2026 buyer who didn't factor insurance volatility into their decision is going to be paying significantly more for their home in 2028 than they ever imagined when they signed the closing papers. That's Layer 5. The math nobody warns you about until you're already inside it. So, is the answer to never buy a house in 2026? No. The answer is to know exactly when buying makes sense and when waiting makes more sense. And to have a framework you can run on any specific property before you make an offer. Here it is. 5 questions. You can run them on any house you're considering right now today. Question 1. What is your true ownership cost? Not just principal and interest. Add taxes, insurance, maintenance at 1% of home value, HOA, utilities, and the opportunity cost of your down payment. If that total number exceeds 30% of your gross monthly income, you cannot afford the house. Walk away. Question 2. Is the metro you're buying in on the Reventure decline list? If yes, you need to underwrite the deal assuming a 5 to 10% price decline in the first 18 months. If the deal still works at that lower price, it might be a buy. If it doesn't, it isn't. Question 3. How long do you actually plan to stay in this house? If your honest answer is less than 7 years, you are mathematically better off renting in nearly every scenario. The transaction costs of buying and selling a home, closing costs, agent commissions, title fees, typically run 8 to 10% of the home value. You need years of appreciation to offset those costs. If you're going to leave in 3 or 4 years, you almost never come out ahead. Question 4. What's your insurance exposure? Get a real insurance quote before you make an offer. Then ask your agent to pull insurance loss history for the property's zip code. If the area is high risk for floods, fires, hurricanes, or hail, factor a 20% annual premium increase into your math, not a 5% one. Question 5. Could you still make your full mortgage payment if you lost your primary income for 6 months? If the honest answer is no, you cannot afford this house. The whole point of homeownership is stability. If owning it makes you financially fragile, you bought the wrong house. Run those 5 questions. If you get 5 yes, maybe it's a buy. If you get even 1 solid no, it isn't. And neither answer is a failure. Both are wins. Because both keep you out of the trap. Let me zoom out for a second. The deeper truth here isn't really about housing. It's about a much bigger pattern that plays out in every financial decision regular people make. The system is built to convince you that not acting is failure, that waiting is weakness, that if you don't buy now, you'll miss out forever. But here's what the data actually shows. The people who quietly build real wealth over decades don't make decisions when they feel pressured. They make decisions when the math is in their favor. They sit out the bad years. They wait for the right moment. And then, when the conditions actually make sense, they move. Imagine a buyer who skips a 2026 home purchase and instead invests that same $80,000 down payment into a low-cost index fund. At an average 8% annual return over the next 20 years, that $80,000 becomes $370,000. Without the property tax, without the maintenance, without the insurance volatility, without the locked-in mortgage rate. Now imagine they wait 3 years for the housing market to genuinely correct, which most analysts now expect, and then buy a comparable house in 2029 at a 4.5% mortgage rate. Their lifetime interest on that mortgage drops by over $150,000. Their down payment now buys a meaningfully better home in a meaningfully better location. Same person. Same $80,000. Same end goal. Different timing. Hundreds of thousands of dollars different outcome. This is what wealthy people understand that the rest of the system never wants you to understand. The most expensive financial decision you can make is acting under pressure. The cheapest decision you can make is doing nothing while the math sorts itself out. The rich aren't smarter. They're just patient. And patience, more than any other single financial skill, compounds into wealth. Let me paint you a picture of what waiting through 2026 actually feels like. It feels like driving past an open house on a Saturday afternoon, seeing the sign, and continuing to drive. Not because you can't afford it, but because you've already run the math and the math doesn't work. It feels like checking your high-yield savings account on a quiet Sunday and watching the number tick up by another $300 in interest alone. Money you would have been forfeiting if you'd put it into a down payment. It feels like sitting at a family dinner where someone asks when you're finally going to buy a house. And instead of feeling defensive, you feel calm. Because you actually know what your situation is. You actually know what the math says. And you know that the right answer for you right now is to wait. It feels like watching the housing forecasts get downgraded, watching the inventory rise, watching the mortgage rates ease back down, and realizing you have a front row seat to a market correction that the people who already bought are about to feel. It feels like becoming the person in your family who actually understands money. Not because you bought the house. Because you didn't. And that mindset shift, honestly, is worth more than any single house ever could be. So, there you have it. The 5 layers of the 2026 housing trap. The mortgage rate standoff. The localized bubble. The forecast reversal. The true cost math. And the insurance wild card. The way out is the 5-question framework. True ownership cost. Metro risk. Length of stay. Insurance exposure. Loss of income survival math. Run that framework on any house you're considering. Right now. Today. If you get 5 yes, maybe it's a buy. If you get even 1 no, it isn't. And neither answer is a failure. Both are wins. If this video helped you make sense of the 2026 housing market, hit subscribe so the algorithm shows you the next one. We're going to break down dozens of these financial decisions together over the coming months. Your future self is going to thank you for the decision you make today.